Ever wondered how a PE ratio works in an ASX company? Well, you're in the right place because today, we're going to lift the veil on this critical financial metric. The price to earnings, or PE ratio, is a tool that investors and analysts use to determine the market value of a stock relative to its earnings. In other words, it's a measure of what the market is willing to pay for each dollar of a company's earnings. This might sound a bit abstract now, but don't worry. We're going to break it down piece by piece. So by the end of this video, you'll have a solid understanding of how the PE ratio works, why it's important, and how you can use it to inform your investment decisions. So, ready to dive into the world of PE ratios? Let's get started. First things first, what exactly is a PE ratio? Well, PE ratio stands for price to earnings ratio. A bit of a mouthful, isn't it? But don't worry, once we break it down, it's quite straightforward. This ratio is a valuation ratio of a company's current share price compared to its per-share earnings. Let's unpack this a bit more. The P in PE ratio stands for price. This is the market value per share. It's the price that the market, meaning buyers and sellers, agree upon as a fair value for one share of the company's stock. The E stands for earnings. This is the company's earnings per share, or EPS. Now, earnings are a way of measuring a company's profitability. Think of it as what's left over after all the bills are paid. The EPS is calculated by dividing the total earnings by the number of outstanding shares. So, to calculate the PE ratio, we simply divide the market value per share, the price, by the earnings per share, the earnings. The resulting number gives us a value that represents the amount an investor is willing to pay for each dollar of a company's earnings. Essentially, a high PE ratio could mean that the stock's price is high relative to earnings and possibly overvalued. Conversely, a low PE ratio might indicate that the current stock price is low relative to earnings, suggesting it could be undervalued. But remember, like all indicators, the PE ratio isn't a crystal ball. It doesn't predict the future. It's just one tool in an investor's toolbox and should be used in conjunction with other metrics and information to make informed investment decisions. Now that we've broken down what a PE ratio is, it's time to understand how it works. So, how does the PE ratio work in an ASX company? Well, let's dive into the fascinating world of financial ratios. The PE ratio, or price to earnings ratio, is a tool that investors use to determine how much they're willing to pay for each dollar of a company's earnings. It's calculated by dividing the market value per share by the earnings per share. In the Australian Securities Exchange, or ASX, the PE ratio is a commonly used metric to assess the relative value of companies. But what does it really mean? Imagine you're at a car dealership. You wouldn't buy the first car you see without comparing it to the others, right? You'd look at the price, the specifications, the brand reputation, and so on. The same principle applies when investing in stocks. The PE ratio helps investors compare the value of different stocks, much like comparing cars in a dealership. If a company has a high PE ratio, it could mean that the stock is overvalued. You can think of it as a fancy sports car with a hefty price tag. But just like a sports car, a high PE ratio could also suggest that investors are expecting high growth rates in the future. They're willing to pay a premium for the promise of high returns. On the other hand, a low PE ratio could mean that the stock is undervalued, similar to finding a good, reliable car at a bargain price. However, a low PE ratio could also indicate that the company is not expected to perform well in the future. It's like a car that's cheap because it's old and has high mileage. It's crucial to note that the PE ratio is just one of many tools investors use, and it should not be the sole factor in making investment decisions. It's like using only the price tag to decide which car to buy. You wouldn't do that, would you? Instead, you'd consider various factors before making your decision. So, when investing, use the PE ratio as a starting point, but make sure you consider other factors too. Remember, knowledge is power, and in the world of investing, it can also be profit. Now that we've understood how the PE ratio works, why is it important in investing? Well, the PE ratio, or price to earnings ratio, plays a crucial role in investment decisions. This nifty little ratio gives you a snapshot of a company's financial health and future prospects. In essence, it's like a window into the company's soul, if you will. It's all about understanding the worth of a company. When you invest, You want to know if you're getting your money's worth. The PE ratio helps with exactly that. It tells you how much you're paying for each dollar of the company's earnings. If the PE ratio is high, you're paying a lot. If it's low, you're getting a bargain. Now here's where it gets interesting. You can use the PE ratio to compare different stocks. Say you're going grocery shopping. You wouldn't buy the first apple you see, right? You'd compare different apples to find the best one. The same principle applies to investing. By comparing the PE ratios of different companies, you can find the most valuable stocks for your portfolio. But remember, the PE ratio isn't the be-all and end-all. It's just one piece of the puzzle. You still need to look at other factors like the company's growth prospects, industry trends, and economic conditions. In essence, the PE ratio can be a handy tool for investors when used correctly. So, let's wrap up what we've learned today. We've delved into the PE ratio, a vital tool in evaluating a company's value on the ASX. We've broken it down, understanding its components and how it operates. We've also emphasized its significance in investing, guiding us in making informed decisions. Remember, this is not financial advice, and always consult with your financial advisor before making any investment decisions. Thanks for tuning in, and until next time, keep learning and keep investing.